Well, what's been holding up this economy so far has been today's Supreme Court ruling to the end of the president's student loan forgiveness plan. What it means for some 40 million Americans that are now on the hook to pay back $20,000 in loans, and that could impact certain groups of stocks in particular as those people budget and change their spending habits. So joining me now is Dominic Gabriel, Oppenheimer analyst, along with our own Christina Partsenevelis, who's been kind of tracking this student loan story and everything else. Dominic, I'll start with you with regard to just what we're seeing in terms of how this will impact the market overall. There are certain places where we could see a benefit and a drawback. Take us through where you think we could see, if you want to call it, a tailwind because of this Supreme Court ruling.
Sure. And thanks so much for having me on today. You know, when we think about our coverage, which is a combination of specialty finance and fintech, what we're really focusing on the upside is for SoFi in particular to their numbers. Unfortunately, it is already baked into our numbers. And so we actually downgraded this stock at 975 just a few weeks ago. But that's really where we're going to see it in originations of federal refinance loans. And that's kind of where we're most focused today on the upside.
So if it's SoFi, then there's a reason why, because they have carved out a niche. It was almost like a part of the genesis of the company to kind of cater towards some of that side of the business. Is it also a demographic trend that you're seeing for SoFi's client base about that particular group that's going to benefit the most as opposed to, say, other payment or fintech type services?
So a lot of their business used to come from student loan originations, and now they've diversified that business quite a bit. And so it's less of a factor, and they've actually been able to hit their long-term targets released in their SPAC deal because of that diversification. They've really kind of leaned into personal loans. Believe it or not, you actually don't see a lot of overlap between their student loan product and those customers and the other rest of their customer base within their financial segment. And so there's not as much overlap as one would think, which means less credit risk.
All right. So Christina, the fintech story you can kind of see, but take us through how clear it could be in light of or vis-a-vis the decision that just handed down right now.
Oh, I'll use SoFi because it's just being discussed. And I question the run-up in the stock. It's more than doubled this year because we keep talking about refinancing and how that's going to help volumes. But JP Morgan actually put out a note not too long ago saying that in 2019, 2% of student loans were refinanced. And that was when you had historically low interest rates. So why are we of the notion all of a sudden that there's going to be this massive wave of refinancing when for the vast majority of the people, it's not that beneficial to go with a personal provider like a SoFi versus, let's say, a federal type payments plan. So I do wonder about that in particular for that name. But it would help, if it was the case, it would help a lot of payment providers. You have Navient as one. That stock was a run-up too, and that's because it's a payment processor. But then Sallie Mae is a company that provides individual loans to students who already have loans. So they'll actually probably do worse because student loans need to shift. Their students need to, or borrowers need to shift their money to pay off that debt and not pay off their other loans. So there is a concern there. And then one last point, Dominic, you just brought up the personal loans, which is obviously more beneficial because there's more return for SoFi. But is it not alarming that personal loans are growing and many of them are unsecured, therefore it would lead to delinquencies?
It's a great point. And, you know, we did a note on this as well that, you know, if you look at the average monthly payment of a student loan over the last number of years, you know, it's really above $400 today. And on average, over the last 3 years, it's at $414 by our calculations. And so that would obviously impact borrowers' ability to pay and spend on discretionary categories. Think of all the flights people are taking. Think of all that, you know, that activity that everybody's been doing in discretionary categories, restaurants. All these activities are going to be impacted because there's going to be a shift from consumer spending to bill payment. And all of these factors really do impact. We know that the vast majority of citizens in the United States don't have a lot of savings. And when you think about the average debt they're paying at about $1,000 a month, excluding mortgages, you know, this $400 starts to really matter. And this is part of why on our specialty finance coverage, we do have losses ticking up. And we recently reduced yesterday our American Express outlook for revenue growth because of a number of factors, but this would put more pressure on spending than it would help.